So we got a little bit of time left in 2024, and we got all of 2025 where we can do spread over 2 years. We can capitalize on the low tax rates that we have right now. They're right up here on the board. I want to put it to Tom to just talk about why are we doing this video today.
Yeah, I mean, we're doing this video because taxes currently are on sale. If you look historically back, and we'll go over that in a second, we're in really low tax rates. And those low tax rates are coming to an end. In the current law, 2026, those tax rates are going back up. And so, what we want to do is talk about what are some strategies, what are some things you can do to take advantage of these low tax rates while we have it, or while we're able to. A lot of you have most of your money in 401ks and IRAs, money that has not been taxed. And so you need to have a plan on how to get it out. And so I want to turn it back to Hans. Or actually, before I do that, let's bring up the show notes. The show notes, you can find these at the link below our video. They're also on our website. We have the board, and then we have various charts that I have sitting on my desk that I use all the time when we're doing our planning. We have the, sort of what the current tax rates are. Again, we've highlighted a lot of the stuff that's highlighted on the board. We have one about historical tax rates, like what were they in 2017. We go through, and this is sort of the history of U.S. taxes, what the highest top marginal rate was over time. So again, if you're interested, you can go look at these in the show notes. But let's bring it back to the board and really get down to like, all right, what do we do with this information? What can we do here?
Okay, so you can go find in the show notes, you can look on the board, whether you're married filing jointly or you're filing as a single, which category you're in, and then you can find your income and you can go to what your tax rates are in 2024. Say, well, why do I want to do that? Most of the time, I just wait till April 15th and a computer does that. Well, one of the ways you can affect your income or take advantage of the fact that taxes are on sale is you could plan some Roth conversions between now and the end of the year, and then all of next year, if you're watching this videos where there's still some of 2024 left, is you can do some Roth conversions. And then the question becomes, how much of a Roth conversion should I do? And that's where, when we do this in our planning for you, where we're going to sit down, we're going to look at your income, look at what it otherwise is going to be, how much income you're going to recognize, and then we can use these charts to our advantage and take the advantage, and we might take advantage of some tax rates that are on sale. And this has a limit to it. It's different for everybody. And just as an example, if somebody has an income, they're married filing jointly, of $94,000 a year, then they're paying federal taxes at 12% on some of their money, and they're still paying 10% on the first bit of their money. And so that's a really low rate. And you say, well, I just want to keep it there. Well, if you've got $800,000 sitting in a 401k, maybe more, maybe less, and you've got money, and that money's for your retirement, and you just keep putting this off, you have the opportunity to, if you're this person, to do some Roth conversions and get into the 22% and the 24% bracket. Now all taxes are on sale. Now you're going to have to add to that if you're in an income tax, in a state with a state income tax. You're going to have to add that factor to that. And we'll do all this for you in financial planning. I'd be glad to, where we'll put together a plan. And Tom's going to talk about how you use this in a minute. I just wanted to explain this chart to everyone. If you're a single person and you have an income of $100,000 a year, so you're right at the top of the 22% bracket. And if you let the year expire, you're still leaving money on the table too. So that's the chart. What's here in 2017, you say, well, why do you have 2017 up there? What do I care what tax rates were in 2017? That was the year before the tax reduction, or the Tax Cuts and Jobs Act. And that Tax Cut and Jobs Act has a sunset provision. So it lasts through 2025, and at the beginning of 2026, the sun sets, and the tax rates that are here go to this amount. So they go back to what they were in 2017. That's the current law, and it's political season. And if candidates are talking about what they're going to do to the taxes, they can't do anything to the taxes. Actually, if they could have, they would have done it since 2018. They would have messed with them again. It is very difficult to change tax rates, tax codes. They'll do it, and they're probably going to do it at some point in the future, and it's probably going to be up, not down. And that's just my prediction and my own personal opinion. But this is the current law has these amounts going to this amount. So it's about 4%, 3%, 1%. I mean, when you average all of that, I'll leave the math to you. It's significant, though, of what's going to happen to taxes when they revert back. It's going to be essentially reverse the tax cut. Now, when I talk about they're probably going to go up, when you look at the national debt and you look at how much the national debt is accumulating, and you look at the Medicare program, you look at Social Security, and it's just my opinion that they're going to have to raise taxes. And when we look historically, I just pulled off some rates off of the chart and take you through a little history lesson. In 1918, the top federal tax rate was 77%. That's right around when the income tax started. If you get 1929, which was right when the stock market crashed, 25%. 1932, 63%, right in the middle of the Depression. 1936, toward the end of the Depression, 79%. 1945, the end of World War II, 94% was the top rate. 1965, the middle of the boom, when the baby boom and kind of the end of the baby boom, prosperity, 70%. 1982, the beginning of the Reagan years, the tax rates were 50%, coming off of inflation. In 1988, they had the big tax reform, tax changes 28%. 1993, the beginning of the Clinton years, 39.6%. And it wasn't Clinton alone, it was Clinton and the Congress that passed that. 2003, the end of the Bush first term, and it's Bush in Congress. It's not, no president is going to take responsibility of either side of the cut. I mean, they may try to, but the reality is they were the leader when they all came together and made a change of the tax code. But 2003, 35%, 2013, the Obama second term, 39.6%. The Tax Cuts and Jobs Act, 2018, under Trump, 37%, and that's where they are today in 2024. So with that being said, is I just look at those numbers and I look at how high they are, and I'm comparing them to what they are now and what you can take advantage of possibly with Roth conversions if you're a person that that makes sense for. That's why we're doing this video today. So I want to put it to Tom, and I want him to explain to you a little bit of what you do with this information.
Yeah, I mean, like I said earlier, a lot of people's savings are in accounts that have not been taxed. 401ks, IRAs, stuff you've set aside wisely, but have not paid taxes on it. And you need to have a plan on how to get that money out and not get killed in taxes, right? A lot of people never think about the distribution of that money. It's all about accumulation, saving, letting it grow. And then when they retire, they wake up one day and they're pulling all this money out and they're paying a bunch of taxes, right? It's not ideal. And so what we want to do, just broadly speaking, is have a plan in place of how to get that money out in the most tax efficient way. And so some of the things you can do now, take advantage of these low tax rates, or look at things like Roth conversions, right? A Roth conversion is where you take money from a traditional IRA, pay the taxes on it, and put it into a Roth IRA. And once it's in a Roth IRA, it's tax free because you just paid the taxes on it, and then all the growth, all the gains are tax free as well, which is really sweet down the road. And so that is something that I think is really worth considering when we look at these rates and we look to see what are sort of a sweet spot to do Roth conversions. That 24% tax bracket is a really sort of ideal area. We do a lot of planning around converting to that 24% tax bracket. If you look at for a married couple, the top rate is 300, the top income is 383,000 to before you get into the next tax bracket of 32%. For a single tax filer, that's 191,000. And so it's really wide. You can have a lot of income and stay at that 24% rate. And so I think that's a really kind of a sweet spot here. Now that's not for everybody, right? It a little bit depends on your other income. It depends on how much you have in your IRA. And so this needs to be, tailored to you specifically. This is not sort of blanket advice, but that is an area, especially for people who have significant savings in their 401ks that we're taking advantage of a lot of the time. Like Hans was mentioning, we have these low rates for 24 and 25. 2026, the current law, these are going to go back up to what they were in 2017. The brackets, we don't have the brackets on the chart here because those got indexed for inflation from 2017 up till now. We'll just have to see how that all plays out. But the rate, the percentage, we know what essentially is the 24% bracket now is going to go up to the 28%. So that's a 4% increase in terms of the numbers. And all the lower brackets also increase. And so it's again, it's something to think about when we're building a plan out and we're doing these Roth conversions. Some of the things that we do keep an eye on, because we'll get this question a lot. Well, if I do that, that raises my taxes. Won't I have to pay more for IRMA, which is the cost for Medicare for high earners? And a lot of times the answer is yes, as we are intentionally suggesting you pay more for Medicare now to avoid a bigger problem down the road. So, a lot of times if you have a lot of savings in your 401k, you can avoid IRMA now prior to RMDs or the required minimum distribution. But when you get there, that pushes you into the IRMA at that point. And so a lot of times we're saying, go ahead and pay it now. We build it in part of the plan. We account for it so we can avoid it down the road. So I just want to sort of touch base on that. And then Social Security as well. If you've already started Social Security, you're doing Roth conversions, that's going to cause more of your Social Security to be taxable. But down the road, once it's been converted, now that Roth money doesn't have any impact on your Social Security. So a lot of times it is paying more taxes now to avoid higher taxes in the future. But again, it needs to be specific to you. It needs to be part of a larger plan, and it needs to be intentional, right? I want you to have a plan about how to get this money out in the best way possible for you and for your family so you can keep more of that money and not send it to the government. So I think those are some of the points we make. Again, it needs to be tailored to you. So call us. If you're interested, call us and we can sort of put this together for you.
Now, I personally, I'm 66. I'm paying a ton of IRMA right now because I'm doing quite well in my business and I'm on Medicare and my wife's just going on Medicare. And it doesn't really bother me because I'm doing well. But my plan for the future, I've already done a lot of Roth conversions. In fact, I've converted all of it. And so my plan is whenever I am done doing this and I need to live off of something other than my business, it's going to be Social Security and it's going to be withdrawals from my Roth accounts, which I have in annuities, which guarantee a payment for life and a tax-free payment. So the plan here, and I'm delaying Social Security until I'm 70. So, I mean, my plan is to have a couple of nice Social Security checks, some big Roth IRA income checks coming in every month. And I don't plan to pay any taxes at all or very low taxes in retirement. And that's not so much a quantified thing. You could go back and you could make a case that maybe I could have paid a little less when my income's down, and then I would have paid taxes on Social Security and possibly IRMA. So I don't really care about all those figures. I just know that I have a tax-free retirement or close to tax-free to plan for. And we can create this same kind of zone for you if you have a big glob of money in an IRA and you haven't really thought about the taxes. This is just one of the things that we can do. So, in the terms of comprehensive financial planning, we talked today about Social Security. We talked about Medicare in terms of the IRMA or the Medicare tax. This whole thing of strategy is about converting, either your 401k balance or your IRA balance or some kind to a Roth, which is a tax-free account and have tax-free accumulation and payouts. It's about income, and it's obviously about taxes. That's what the whole show's about. So I want to bring Tom back on. I'm Hans Scheil.
And I'm Tom Griffith.
We thank you very much for listening.
Thank you.